Paying off your mortgage faster can have many benefits, such as saving you thousands of dollars in interest, increasing your home equity, and freeing up your cash flow for other goals. However, it can also have some drawbacks, such as requiring more upfront cash, increasing your monthly payment, or affecting your tax situation. In this video, I will share with you 5 of the most common ways to pay off your mortgage faster, and some of the factors that you should consider when choosing a method to do so. These methods are making extra payments, refinance your mortgage, recast your mortgage, flexible term mortgage, and adjustable rate mortgage. So, how can you pay off your mortgage faster and save money in the long run? Well, there are many ways, but I'm going to focus on 5 of the most common ones that you can start applying today. 1. Make extra payments. This is the simplest and most straightforward way to pay off your mortgage faster. You just make an extra payment every month, every quarter, or every year and apply it to your principal balance. This will reduce the amount of interest you pay over time and shorten the term of your loan. For example, if you have a $240,000 30-year mortgage with a 7% interest rate, making an extra payment every quarter could save you $184,000 in interest and pay off your mortgage 15 years early. To make this strategy work, you need to make sure that your lender allows extra payments without any penalty and that they apply them to your principal balance, not your interest. You also need to budget for the extra payments and stick to them consistently. 2. Refinance your mortgage. This is when you replace your existing mortgage with a new one, with a lower interest rate or a shorter term, or both. This will lower your monthly payment and the total interest you pay over the life of the loan. However, refinancing may come with fees and closing costs, so you need to weigh the benefits and costs carefully. You also need to check your credit score and compare different lenders and loan options before you decide to refinance. For example, if you have a $240,000 30-year mortgage with a 7% interest rate, refinancing to a 15-year mortgage with a 4% interest rate could save you $173,000 in interest and pay off your mortgage 15 years early, but it would also increase your monthly payment by $600. To make this strategy work, you need to make sure that you can afford the higher monthly payment and that you plan to stay in your home for a long time. 3. Recast your mortgage. This is when you make a large lump sum payment to your lender and ask them to recalculate your monthly payment based on the new balance. This will lower your monthly payment and the total interest you pay over the life of the loan, but it will not change the term of your loan. Recasting may also come with a fee, and not all lenders offer this option. You need to check with your lender if they allow recasting and what are the conditions and costs involved. For example, if you have a $240,000 30-year mortgage with a 7% interest rate, and you make a $50,000 payment after 10 years, you could lower your monthly payment by $300 and save $64,000 in interest, but you would still pay off your mortgage in 30 years. To make this strategy work, you need to have a large amount of money available to make the lump sum payment, and you need to be comfortable with the same loan term. 4. Select a flexible term mortgage. This is when you choose a mortgage that allows you to adjust the term of your loan based on your financial situation and goals. For example, you can choose a 30-year mortgage that lets you pay it off in 15 years if you make extra payments, or extend it to 40 years if you need to lower your payments. This gives you more flexibility and control over your mortgage, as you can change the term anytime without refinancing or paying any penalty. However, it may also come with higher interest rates and fees than a fixed-term mortgage, as the lender takes more risk by offering this option. You need to compare different flexible term mortgages and see how they affect your monthly payment, total interest, and loan term. To make this strategy work, you need to have a clear goal for your mortgage and monitor your progress regularly. 5. Consider an adjustable rate mortgage. This is when you choose a mortgage that has a variable interest rate that changes based on market conditions. This may lower your interest rate and monthly payment initially, as you benefit from the low market rates, but it may also increase them later if the market rates go up, as you bear the cost of the high market rates. This can help you pay off your mortgage faster if you plan to sell your house or refinance before the rate adjusts, as you can save money on interest and use it to pay off your principal. However, it can also increase your risk and uncertainty if you plan to keep your house for a long time, as you may face higher payments and interest in the future. You need to understand how your adjustable rate mortgage works, such as how often the rate adjusts, what is the cap on the rate, and what is the index that the rate is based on. To make this strategy work, you need to have a flexible budget and a good sense of the market trends. Now that you know some of the ways to pay off your mortgage faster, how do you decide which one is the best for you? Well, there is no one-size-fits-all answer, as different methods may have different advantages and disadvantages depending on your personal situation and preferences. However, here are some of the factors that you may want to consider when choosing a method to pay off your mortgage faster. 1. The amount of interest you will save. Generally, the more interest you pay up front, the less interest you will pay over time. Therefore, methods that allow you to make extra payments or recast your mortgage may help you save more interest than refinancing or selecting a flexible term mortgage. However, these methods may also require more upfront cash or fees, which may not be feasible for everyone. 2. The impact on your monthly payment. Depending on your budget and cash flow, some methods may lower your monthly payment and make it easier to afford. For example, refinancing or selecting a flexible term mortgage may reduce your monthly payment by extending the term of your loan or lowering the interest rate. However, these methods may also increase the total cost of your loan over time and expose you to more risk if interest rates rise. 3. The tax implications. Depending on how much interest you pay up front and how long it takes you to pay off your loan, some methods may have different tax implications than others. For example, making extra payments or recasting your mortgage may reduce your taxable income in the year that you make them, which could lower your tax bill. However, refinancing or selecting a flexible term mortgage may increase your taxable income in the year that you do so, which could raise your tax bill. 4. The opportunity cost. Depending on how much money you have available and how much risk you are willing to take, some methods may offer more opportunity cost than others. For example, making extra payments or recasting your mortgage may free up some cash that you can use for other purposes or investments that could generate higher returns than paying off your mortgage faster. However, refinancing or selecting a flexible term mortgage may lock up some cash that you cannot access until the end of the term of your loan. Ultimately, the best method for paying off your mortgage faster depends on what works best for you and what makes sense for your financial goals and situation. You should weigh the pros and cons of each method carefully and compare them with other options using online calculators. You should also consult a financial planner or a mortgage expert for more personalized advice. Thank you for watching. I hope you found this video helpful and informative. Please leave a comment below and let me know what you think about it. I'll see you in the next video.